A lot of beginner traders try and learn support and resistance, all the technical tools, trade setups, candlestick patterns, before learning the one thing that makes all of that way easier, and that is market structure. Because if you cannot read the basic structure of a chart, then it becomes really easy to make mistakes, such as, buy in the wrong place, misread the trend, chase bad entries, and just get confused with what the indicators are telling you. So in this video, what I'm going to do is I'm going to show you how to read market structure in a very simple way so you can make calmer and more structured trading decisions. So what we're going to cover in this video, we're going to talk about what market structure actually is, how it works. We're going to identify uptrends, downtrends, ranges, talk about a break of structure and a change of character, which are really important. Briefly talk about multi-timeframe structure, and then just talk about how market structure connects to the other tools for better entries. So if you can master market structure, everything else in technical analysis becomes much easier. So let's jump right into it, and we'll start by learning the three market environments. Now, in this video, we're going to cover market structure. Eventually, you're going to want to connect market structure with various tools when you learn an actual strategy. So below this video, you can come to our Stock Trading for Beginners group. It's the first link in the description. You can join this for free. We do live calls every week. And in the classroom section, we have a full trading strategy course. And after market structure, we learn all the technical tools and how to use them and apply these strategies. So once you're done with this video, certainly you can come and join our free Stock Trading for Beginners group on School. So the first thing that we want to do is we want to understand that market structure is basically the overall shape that price creates on a chart. So if we jump to TradingView and we just look at this chart here, this is a weekly chart of NVIDIA. So these candlesticks represent 1 week. And we can see that in the October 22, the bottom of the bear market here, the price action for NVIDIA was extremely bullish. And we can see that what basically has been carved out on the chart is market structure. So it's the shape that the price action creates on the chart that's referred to as market structure. So there are basically three environments with market structure. There's an uptrend, a downtrend, and a range. So we're just looking at NVIDIA. This is an uptrend. We've gone from $11 to $200 in a few years, October 22, we're in 2026, May right now. So it's a 20x. This is an uptrend. We can look at the market structure and what it's carved out on the chart. And this is an uptrend for this particular stock. If we go ahead and we look at a different chart, this is clearly not an uptrend. This is a downtrend. So this is UPS. And we can see the stock went from $230 in February 2022 down to $80 in October 2025. So this is a downtrend. The market structure is very bearish here. And then we can look at stocks like GME. So for 2 years, nothing's really happened with this stock. We've sort of just consolidated in a range around the same price. So with an uptrend, you can basically state that the buyers are in control. So all of the dips are being bought up. More buyers are stepping in. Everything's getting bought. People sell, it gets bought up, and it 20x's in a couple years. Here, UPS, the sellers are in control. Everything gets sold. The buyers step in, but they get overwhelmed by the sellers. It's a downtrend. And for GME, there's no real winner here. It's just consolidating sideways. So those are the three environments: an uptrend, a downtrend, and a range. Buyers are in control in an uptrend. Sellers are in control in a downtrend. So, unfortunately, some traders, they jump right to indicators without really knowing what kind of environment the stock is in that they are trading. And that's going to lead to mistakes and some bad trades. So we really want to understand that market structure is the big picture, and it tells us who is in control of the stock at the moment. So now that we know the three environments, we need to learn how to basically read market structure, the language of the structure. So an uptrend is made up of higher highs and higher lows. That's HH. and HL. And a downtrend is made up of lower highs and lower lows. So that's LH and LL. And there is this really important distinction between wicks versus closes that almost everyone gets confused on. So let's jump over and actually look at some labeling on these charts now. And we're going to cover this idea between wicks versus closes. So if we jump to UPS and we just put on some drawings here, we can kind of just look at this and this basic diagram is market structure. So we have a higher high and a higher low. We have an uptrend in this area. Then we have a lower high and lower lows, and we have a downtrend in this area. So if we just zoom in here, and we look at what is actually happening with this simple diagram, then we're going to jump to an actual chart and actually look at it because it's a lot more messy on real charts. We can see that price comes up to a high and it pulls back into a low. And then as price comes up here and it starts closing candles above this previous higher high, we continue the trend up. So we have a break of structure to the upside and we make a higher high and a higher low, and the trend is moving up. We're making higher highs and we're making higher lows. So that is an uptrend. And then in this area, it's the opposite. We are sort of walking down the stairs. We are making a high here, which is lower than this previous high. And we have a low here, and now we have a lower low, which is this low is lower than the previous low. So we're making lower highs, lower lows, lower highs, lower lows. We are in a downtrend. So if we looked at NVIDIA, and again, this is a weekly chart, but this applies to all the different time frames that you're looking at, whether it's an hourly chart, 15-minute chart, monthly chart, and so on. And we put on some indicators here. We can go ahead and we can actually label a real price chart. So I'll zoom in here a little bit so we can kind of see what's going on. So from the bottom here in October 2022, in this area, we made a high, and this high was lower than this high. So it's a lower high. And then this low is actually higher than this low. So we make a lower low, and then we make another low, but it's higher than this low. So it's a higher low. And then we move all the way up here. We were extremely bullish. And then we make a higher high in this area and we make a higher low. So we are trending up. Then we come up to this area where we make a higher high. So this high, it's higher than this one. This low, it's a higher low than this one. We are trending up and we continue to trend up. This high, it's higher than this one. This low, it's higher than this one. Higher low, higher highs, higher low. And we continue trending up until the present time where we've made a higher high and we've sort of just consolidated in this time, this sort of late 2025, early 2026, when the market was at resistance and sort of just consolidating after this big run up. So that is higher highs and higher lows in a bullish uptrend. Now, if we look at UPS, we can see we have a downtrend. We can kind of zoom in here, and I've gone ahead and labeled some of these for this demonstration. And we can see we'll just kind of start somewhere here. This low is lower than the previous low. This high, it's lower than this previous high. So it's a lower high, lower low. We make another low that's lower than this one. We make another high that's lower than this one. We are trending down. And then this low, it's lower than this one. This high, it's lower than this one. It's a lower high, lower lows, lower highs, lower lows, all the way down into this area. So we wouldn't want to buy anything in this type of market structure. This is a downtrend, making lower highs and lower lows. We are trending down. And NVIDIA, this is bullish market environment. It's bullish market structure. We're making higher highs, higher lows, higher highs, higher lows. We are trending up. So those are the basics of market structure and labeling. And it's always easier to label things on a simple diagram like this. But once you go and look at a real chart, things get a little bit more messy. It doesn't always smooth out and make perfect peaks like this. And this is really when we have to learn this important distinction between candle closes and wicks. So I'm going to jump over to a coin chart here for this demonstration. And I'm going to briefly talk about this here. If for whatever reason, if you're watching this and you didn't quite get this explanation, then in our group, in our classroom section, under the trading course, Module 3, Lesson 1.1 is another full description of what I'm going to talk about here, understanding the basics of wicks versus closes in market structure. And it's going to be a much thorough explanation with some diagrams that you can cover. And if you don't really understand this part, then certainly come to the community, send me a message, or just post a question. But the important part that I want to talk about is for market structure, where the present day candles close in relation to the prior lows of the wicks is really what matters for telling us if we've made a higher high, a higher low, or lower high. So we can see that in this present time, we are looking at February 26, March 26, April 26. All of these candles, they all closed above this wick. So this candle closed here. This candle is green. It closed there. This candle is going to close up here. So all of these candles, they closed above the previous low here. Therefore, market structure was intact. There was no change of character. We didn't make a lower low. Now, it might look like this candle, right, wicked down here and it made the lowest point out of these prior lows. But it's really important that we focus on where the candle closes, not where this wick is. So this candle, we want to look left. The lowest point prior is down here, and this candle closed up here. Therefore, it closed above this low. It is a higher low. It's not a lower low. In this area, this candle closed here, and this candle closed here. However, this candle in April, it went all the way down here, which was technically lower than this wick. But we want to, again, focus on where this candle closed. This one closed here, this one closed up here, and that is above this prior low wick. So in both of these examples, the market structure was intact. We made a higher low, a higher high, a higher low, a higher high, and a higher low. So although this stock coin is extremely volatile, what we have is we have good market structure. We've made a high, we've made a low, we made a higher high, a higher low, higher high, higher low. So yes, this is volatile. It's run up and it's run down. Volatility goes both ways. But on this high time frame chart, which is a monthly chart we're just looking at here, there was never a breakdown. We did not break down and go down like we look at this UPS chart. This, if we switch to the monthly chart for just a visual, that's maybe comparable here. We have lower lows. We have a low here, this low. Now this candle closed below this low. This candle closed below this low. This candle closed below this low, and so on. This is lower lows, lower highs. We are trending down. We're breaking structure to the downside. Coin, it's not. We are maintaining this area. So on the high time frame, although the stock is volatile, it has not broken down. So that's a really important distinction between where the current candles close in relation to the prior lows. So we take the prior low wick, that's the low point. The candles closed above it, therefore market structure is maintained. We do not make a lower low. So that's a really important concept. Sometimes if you watch that for the first time, it might not sink in. It still might be confusing. Again, come to our class and our course, our group, ask questions, get some clarity on it, and eventually it's going to sink in. So that's the basics of reading market structure. And now we want to talk about two important concepts with market structure called a break of structure, or BOS, and a change of character, a CHOCH. So a break of structure means confirmation, and a change of character means a warning sign that a reversal might be happening. So what we're going to do is show a demonstration for this because it's the best way to learn. And we're going to jump into our diagram here, and then we're going to jump into the real charts. So let's start with a break of structure. So a break of structure means trend continuation. So a break of structure happens when candles close above a previous higher high or a previous lower, or on the downside, below a low. So we can have a break of structure in an uptrend and we can have a break of structure in a downtrend. So a break of structure happens right here where we make a higher high, we make a higher low, and then candles start to close above here and they close above this higher high. That is a break of structure. It's an indication that the trend is continuing up and we continue to close candles above this high. We are breaking structure to the upside, trend continuation. And then we have another break of structure right here. So right here, when this candles and this area here, we start closing candles above this high, we have a BOS to the upside, we have a break of structure to the upside, we have trend continuation, and then we have another BOS right here. So this indicates trend continuation. We are breaking and closing candles above previous highs, indicating that the trend is continuing and we are continuing up. Now we can also have breakup structures to the downside. So when we have a lower low here and a lower high, and then right here, we start closing candles below a previous low in a downtrend. That is trend continuation. That's a break of structure to the downside. So a break of structure is trend continuation. Now, right around here, we have something different. We have what's called a change of character. So our price action here, we have a higher high, a higher low. We break a structure to the upside, a higher high, higher low, break of structure to the upside, higher high, higher low, break of structure to the upside. We make another higher high. And what happens right here is price comes down to a higher low, and then we make our first lower high. So this is our first little warning sign that maybe the trend is changing. And then what happens is price comes down and it starts closing candles below these lows. So right here, what we have is we have our first change of character. It's a warning sign that perhaps the trend is changing. It's a warning sign. It's not official. It's not confirmation completely, but it's a sign that perhaps the market is changing its character from bullish and uptrend to potentially bearish and a downtrend. And what happens here is price goes down and then it also closes candles below this low. So there are two types of changes of character. Okay. There is this one. And then we also have a change of character right here. So this change of character is basically what we refer to as an official change of character because it closes below the low that was associated with the last break of structure to the upside. So this is a change of character as well. This is one that's a bit more official. Sometimes this first one can be a fake out. We want to also confirm with this one. So that is basically the rule with changes of character. This is a change of character. However, when price closes below this low, it's seen as more official. Probability that the change of character and the trend is changing is higher because this is a really important low. It's associated with this last break of structure to the upside. And then what happens is we make a lower low and a lower high, and then we have a BOS to the downside. So there's more confirmation that the trend is changing. We have a change of character. We have another change of character here. And then we have a break of structure. So all signs that the trend is changing. Your lower high is your first warning sign. Change of character is a warning sign. Here's another one that's official. And then we have a break of structure that confirms everything. So that's the basics of a BOS and a change of character. So what we can do is we can look at this on an actual chart. So we'll go back to the weekly chart here for UPS, and we can just start right here, and we can see that where we've just labeled this, we've opted to just not label every single high and low, just we'll keep the labeling quite clean here, but we'll have a high here and we have a low. So this red bearish candle, when it closes when it closed this candle below this low, what do we have right there? That is a BOS. That is a BOS. The way we've labeled it here, if this is our high and that's our low, and then we have another low here, we have a break of structure. This candle that's down 11% is a continuation. It's a break of structure. It signals that the trend is continuing to go down. It's trend continuation. We make a lower low, we make a lower high here, and then we get another red candle down 14%. So here we also make a break of structure right there. So another sign of trend continuation. And then we've gone down and labeled that a lower low, a lower high. So what do we get right here? We get another BOS right here. So another sign of a trend continuation and so on. And we're almost at the bottom here, this low. And what do we get with this big red bearish candle? We get another BOS to the downside. This candle's down 20, almost 20%. There is a bearish candle, closes below a prior low, trend continuation to another lower low. Now, what we have here is something different. We no longer continue making lower lows. We actually start making a lower high. So this lower high right here is really important. And what do we get when we close a green candle above this one? We no longer make a break of structure. We have a change of character. This is the market structure telling us that we are no longer making a lower lows. We've actually closed candles above a prior lower high. That is a change of character. We are changing the character from a downtrend to potentially an uptrend. So we have a change of character. We actually now make a higher high. So this high, it's higher than this high. We're no longer making lower highs. And then we come down into a higher low. So in this area, now we aren't making lower lows. We're not trending down anymore. We've had a change of character. We close candles above a lower high. We make a higher high, and then we make a higher low. And UPS looks like its trend has changed. It's no more bearish. It's maybe looking a little bit more bullish. And the market structure told us this. It told us this with this green candle closing above a lower high, making a change of character, make a higher high, we make a higher low, and we are potentially trending in a better direction. Obviously, this stock has been completely bearish the last few years, and we've had a change of character. So that's a break of structure and a change of character, and that is how they work. So these simple diagrams can be helpful, but it's always good practice to actually go and look at this stuff on a real chart. And it's also important to keep that consideration with the wicks and the candle closes. We want to look at how the candles close in relation to the wicks. So this red candle, when it closes below this wick, that's your official break of structure. And when this green candle closes above this wick, that is your official change of character right there. Okay. So that's break of structure and changes of character. Those were done on a weekly chart. And you can do them on different time frames as well. So if we look at multi-timeframe structure, that really tells us the sort of full story of a stock. You can start with the monthly chart. That gives you the big picture. The weekly can be used for directional confirmation. Then you can zone in to the daily chart for more short-term structure, 4-hour chart to see the shifts in momentum, and then even lower if you're sort of day trading and things like that. So you can kind of view the market structure in this way where the monthly is sort of the map, the weekly is the road, the daily is the lane, and the 4-hour time frame is sort of the car that you drive. If you're ever worried about a stock, just check the monthly. And if the monthly market structure is still intact, then it's probably doing okay from a high time frame structure. So if we just look at two quick examples, we can look at Microsoft. This was a stock that we spoke about in our group. which was a good opportunity because we were making a deep higher low, but we never lost any market structure. Or we had a low here from the tariffs in April, and we came here and we closed the month here, and we closed, and we're going to close April up here. So we've made a higher low. It's Microsoft, it's a Mag 7 stock, and deep higher low. This was a great opportunity. Market structure was maintained, and we've got some other technical indicators that helped us with that decision. And then on the flip side, if we want to look at a lower time frame, this is a Bitcoin 4-hour chart, and it's told us where there may be a first signs of a change of character on a shorter time frame that can help us distinguish between a momentum shift that might be starting. So this wick down was the low in March, down at 65,000 there for Bitcoin. And we can see here we had a break of structure. So we have a high here, a lower high. We make a break of structure. We make a lower low. And then on the 4-hour chart, when these green candles closed above this high, that's your change of character. And we start to trend better. And we're looking at the time we're recording this, that Bitcoin is actually trending better. And it's got a change of character on the low time frame, the 4-hour chart, and the trend could be changing. Now, one quick example, what we eventually want to do is combine market structure with our technical tools, so other tools. So for this example, if we just throw on a moving average, what we can see here is we're starting to add confluence to things now. We have a change of character. We have a back test of a 50-period moving average. It maintains, and Bitcoin continues to go up, and we're maintaining this 50-period moving average. So eventually, what you want to do is you want to take your market structure, combine it with some other technical tools to help you with entries and to get an even fuller picture of what the stock or the asset is doing. So basically, to wrap up this lesson, the last point is just that structure should lead your entries. So we want to start with understanding market structure. If the structure is bullish on the various timeframes that you're interested in, then we can look for support through some other tools. If structure is bearish, then we want to be cautious and maybe wait or maybe move on to some other stocks. And then we can layer in our other tools. And again, with our strategy that we focus on mainly on this channel is we want to focus on the one rule where we only buy support and we never buy resistance. So again, structure comes first, and then we can add in our other tools. So to recap this video, again, market structure is the foundation of technical analysis. If you understand, uptrends, downtrends, consolidation, or ranges, if you understand your higher highs, your higher lows, that break of structure for trend continuation, a change of character, meaning a warning sign in the trend, and then how to kind of fit it all together with multiple timeframes, then everything's going to be easier. You're going to be calmer about where the stock or the crypto or the asset is. Your entries are going to be better because you're going to align them properly with the market structure. You're going to avoid buying resistance or buying stocks that are trending down. Then you can start adding your technical tools and find what's called confluence and so on. So everything is going to be easier if you can get a good base of market structure. And that's really what you want to start with when you're analyzing a stock. So I hope that you found this video useful. Again, below this video, you can come to our free trading group on School. We do a weekly call every week. We have a full strategy course that starts with market structure, and then we layer in other various technical indicators to help us find support, find resistance. We want to buy support. We want to be cautious and potentially take profits at resistance. So you can find a link to that. You can join for free. And one thing that I would recommend is that when you start learning market structure, you really need to start practicing it. You need to look at some charts, be able to label those things that we talked about, the higher highs, the higher lows, the lower highs, the lower lows, and then label breaks of structures, label changes of character, and so on. So we talk about more of that in our group. You can always post questions, get feedback on charts if you wish. And again, you can find a full strategy course below. So I hope that you found this useful, and I look forward to chatting with you in our community.